like you.
Hey folks, welcome back to the channel. HappyCattyCrypto here. So welcome to this morning's live stream. And it's a bit of a creeper. I knew this proposal was coming. Well, not proposal, this text. Sorry, I need to get my wording correct. I knew this was coming. I just didn't think it would be. In fact, I thought it would be yesterday, but you know, Monday. It's caught up with us. It's here, and we have a Repeg idea. And disclaimer, I didn't have anything to do with this. I don't have anything to do with it, and I'm reading it from a neutral standpoint. So, you know, thanks for joining us. I'm going to give it a couple of minutes just before I start reading into it, allow people to join if they want to join, so to speak. But, you know, this in itself, just go into this with the most neutral mind that you can. Okay, guys, just try and stay neutral at all times. It's not a short read. It's probably going to be about an hour's stream. So yeah, when Lambo. Exactly. My question is when utility, really. But, you know, that's my own personal opinion. So, folks, like I said, it's going to be a bit of a long read. So I've read through it once. A few things there that I don't like. A lot of stuff that I do like. It's a good plan. It's a very good plan. But yeah, so pretty much, thank you for being here, and you know, thank you for showing up all the time. Thank you for supporting the channel. Thank you for just supporting me in general. Like, this is my 9 to 5, so to speak. Apart from it's not a 9 to 5, it's more like a 48-hour shift and then 6 hours off, then 48 back on. So good morning, good evening, good afternoon, wherever you're hailing from. Let's dive straight into it. So the Terra Classic Repeg updated proposal: Alex Forshaw, Edward Kim, Maximilian Bryan. And sorry if I get my pronunciations wrong. I'm terrible with pronunciations. Abstract. We propose to restructure Terra Classic's USTC via creation of an algorithmic fungible token, USTN, collateralized by a decentralized reserve initially of BTC 60%, and LUNC market capitalization, variable safeguarded by a capital control system with major improvements relative to Terra's legacy CCS. Like I said, it's going to be a long one, so there's disclaimers in here. I'm not going to read stuff like this because it's a bit obvious what the disclaimers are going to be. Pretty much saying it's not a security, a commodity, or anything of that kind of form. We take the legal position that under current law, LUNC and USTN are not securities. We also do not believe USTN should be considered a stablecoin. It gives the definition here of what a stablecoin should be. And while we are algorithmically hardwire USTN to mimic roughly 99 to 1 parity with the USD most of the time, we forthrightly acknowledge that this will not hold under 100% of probable supply-demand scenarios, and provision to manage those unforeseeable contingencies in a way that prevents catastrophic death spirals. To the best of our ability, we believe USTN should never be seen as synonymous with USD and disavow any attempt to market it as such. Every number in this proposal is for illustrative purposes only and is subject to a governance vote. However, every key parameter has significant codependencies with other parameters which should be respected in the governance process. They should be voted on in groups as opposed to an individual vote. Parameters subject to governance approval are denoted with braces parameter. Okay, mission statement. Are you all still with me? Is everybody happy with the sound and everything like that? Before we continue, throw some penguins down, tap that like button if you are in this till the end. So we believe a decentralized economy needs decentralized money. We see USTN as a groundbreaking financial innovation offering unique costs and benefits that differentiate it from custodial stablecoins USDC, USDT, and BUSD. Non-custodial crypto over-collateralization, stablecoins DAI, RAI, USK, others, or under-collateralized fully convertible stablecoins like FRAX. The proposed USTN key differences versus UST would consist of high censorship resistance, a smart contract based decentralized reserve management system, a much higher level of exogenous reserves with a reduced growth capacity, augmented capital controls, and native interest rates set by market focus. As you can see, we've got an AFT market fit with the stable coin trilemma. Whenever I see something like this, it just screams trifecta in my head, but you know, that's just my brain. So as you can see here, a lovely little chart to pretty much kind of, you know, break things down to you. Gabriel, welcome. Appreciate you becoming a huddler and a member. And let's move on. We believe USTC's decentralized stability mechanisms and backing via decentralized assets, mainly BTC, were visionary product design features which validated its claim as the first truly self-sovereign decentralized stablecoin. USTN strives to evolve these product design decisions, not abandon them, to meet the significant demand for sovereign yet stable utility in the crypto economy, which isn't currently being met. We see the US dollar as much more than another fiat currency. We see it as a key strategic asset of the United States, the software backbone of global commerce, and a potential key partner for our protocol. We believe our industry can bring much needed upgrades to a monetary operating system that's 50 years old, weighed down by ever greater inefficiencies, unable and unwilling to be fixed from within. We believe the day will come when US regulators see us and our industry not as threats, but rather as key partners who could buttress the USD as a core operating system of a global commerce for the next 100 years. We believe this proposal preserves the best of Terra's uniquely self-sovereign feature set, dramatically enhances its anti-fragility, and best positions Terra Classic for the next chapter in the greatest turnaround in digital asset history. Alex, Ed, and Max. Just going to take a sip from my tea, folks. Let me know what you're sipping on in the comment section. Thank you so much for that donation too, Gabriel. I really appreciate it. How old am I? I'm 30 next month. Ferdinand Usak. I'm just drinking normal British tea. It's, what is it? I can't even remember what the tea bags are called now. Something fancy. Repeg. There really are some really negative people today on Twitter about, you know, oh, when's Binance going to burn? It's coming, like the dragons in Game of Thrones. They're coming. Moving on. The basic steps envisioned here are: 1. Use some of the time between now and the COSWASM upgrade, estimated 5 weeks, to rewrite the Terra Classic module sitting atop the currently outdated Cosmos SDK. 2. After the COSWASM upgrade completes, airdrop a new token USTN to existing USTC holders on a one-to-one basis, excluding a TFL and related party blacklist. Yes, big FU to TFL there. Along the lines of previous public discussions, the supply of USTN would then be collapsed by 97% in a subsequent step. 3. Regarding the 49.79% of UST supply in the blacklist addresses, instead of airdropping USTN to them, airdrop the USTN that would have gone to them into the community pool instead. 4. Mimic the effects of the previously discussed USTC based off burn via the new USTN token by applying a burn rate of approximately 1 USTC market price to the airdrop USTN call, these different USTs, leaving all USTC intact, but signaling that an ongoing forward basis we intend to back USTN and not USTC within the protocol assets. Example: if there are 10.736 billion USTC equivalent tokens, 9.81 billion USTC, which is 902 million USTC worth of SDTC, 28 million of USTC worth of KRTC plus other dust in circulation today, and USTC is 0.3 BUSD. USTN supply at the end of USTN to equity swap would be 97% below current USTC equivalent supply for a current USTC holder. I hate white screens. I don't think there's a way to change this either. God, it's blinding, isn't it? Hang on a second, let me just put my night mode on, folks. I think it might turn the screen a little bit yellow for you guys, but you know, it might actually look better for you now. Does that look better now? Is that a little bit softer on the eyes, guys? Where was we at? We was at 4, weren't we? Yes. So, we've done the example. 5. The community would agree on a swap rate for LUNC USTN. The amount of new LUNC to be airdropped per each burnt USTN. This proposal assumes a 48 5-to-1 LUNC to USTN swap rate, retiring USTC bad debt at a 50% premium to face value, currently 0.032 cents. The swap rate determines not just the amount of LUNC given to USTN holders, but also the amount of LUNC given to the community pool necessary to buy the BTC needed to collateralize USTN. In other words, 49.83% of the minted new LUNC, yes folks, new LUNC, you heard it right, will be exchanged at the market prices for BTC, which will ensure LUNC against death spirals in the future. B. The community should closely scrutinise the market swap rate after this proposal is aired. 6. Execute the debt for equity swap, creating a new supply of 405 billion Lunar Classic, 49.8%, which is 251 billion of which would go into the community pool, and 253 billion of which would go to off-blacklist USTN holders. A. Stake the USTN holders 253 billion new LUNC across the existing validator set, thus improving network security and applying the standard 21-day staking lock on newly minted Lunar Classic. 7. Migrate 80% of the Lunar Classic in the community-owned smart contracts, Terra, Oracle rewards, and distribution core into the community pool. 8. Create a Terra-wrapped BTC functionality which doesn't currently exist to securely manage the reserves of BTC collateral on-chain and ensure community control over the BTC at all times. So down here you've got if USTC within the blacklist wallet started to move in reaction to this proposal, we'd be forced to snapshot the airdrop before those movements began. Were this to happen, we'd expect USTC's market value to quickly plunge in value, reflecting the pointlessness of holding USTC past the time of snapshot. You've got 2 addresses here. 5. In Terra Classic's old version, the Lunar Foundation Guard's assets were necessarily spread out across multiple chains in wallets that seemed to be largely under Do Kwon's control. Although significant pieces of information remain missing, we have found no evidence that Do Kwon did anything illegal or improper with any of these assets. However, this is a major unnecessary central point of failure which should be eliminated. Any single individual or multi-sig owner of these assets would effectively have a life or death power over the stablecoin and the wider protocol. A. Additionally, the community must control the bridge where BTC, which creates the wrap TW is wrap BTC, by the way, folks, is vaulted. Putting the BTC in a foreign bridge would give another protocol life or death power over our survival. 9. Create a smart contract auction to swap the community pool's Lunar Classic to TW BTC at a discount rate sufficient to fund the reserve. We are over pessimistically model at 10% discount. 10. Once the wrapped BTC auction is complete, move the wrapped BTC into the reserve tranches to collateralize USTN. 11. Reopen the swap with extremely tight parameters, thus aggressively taxing USTN, which inevitably exits the system at first. A. Arbitragers attempting to optimistically leech the 50% ARB spread meant as an outstretched hand to wounded USTC holders who are still committed to remaining within the Terra Classic community would find themselves being slapped with a 40% exit swap tax if they tried to leave immediately. 12. Slowly widen the swap parameters over time. Just going to take a sip from my tea. Folks, let me know what you think so far in the comment section about what I've read through so far. We're not even halfway through, by the way. We've just gone about the 25% mark. Okay, why USTN instead of USTC? After extensive input from the community, we decided that executing the previously discussed debt for equity swap via a new token USTN carried several compelling advantages over the previous plan of a mass burning of USTC. 1. Democratic legitimacy. We respect the free will of USTC holders. We maximize USTC holders' democratic choice by not unilaterally burning their USTC tokens. B. We'd allow USTC holders to retain their original tokens in the event of a future airdrop by Luna 2.0 or any other entity. And we'd allow USTC holders to retain any residual value of their USTC after we communicate to the market that we no longer back USTC. 2. Legal. We'd deflect inevitable legal accusations of seizing or destroying others' USTC without their consent, especially USTC subject to legal claims within the Luna Foundation Guard. By taking the USTM route, we wouldn't be interacting with the LFG or other wallets in any other way. We'd simply be declining to include them in an airdrop, which anyone has the right to do, and then shifting our protocol's intentions from backing USTC to backing a new USTN token. No interaction equals no basis to litigate. 3. Breaking with TFL. By creating a new token, we underscore the break TFL while also emphasizing USTN's more prudent and decentralized implementation of UST original vision. The main disadvantages of going with a new token would be 1. Airdrop execution uncertainty. Given how much USTC is on CEXs as opposed to the chain, there would be significant uncertainty in terms of how many USTC holders would be allocated their USTN. Airdrops have been a long time severe pain point with CEXs, and if anything, this will be a significantly worse than average, given the number of overlapping technical issues. And this is already, off-putting, isn't it? To here there would probably be a lot of issues with the snapshots for the airdrops. 2. Data integrations. We'd have to integrate this new token into major arteries of the DeFi ecosystem, such as Uniswap and Curve. Web portals like CoinMarketCap and the list of tokens on CEXs, the CEX listings in particular will cost a non-trivial amount of time and money. Oh, sorry folks, didn't mean to bump that then. This proposal emphasizes the financial aspects of USTN's AFT relaunch with a high-level review of its decentralized reserve and capital control system. The technical details of the decentralized reserve and CCS will be fleshed out in separate white papers. 2. Feature set. Our product design has one goal: to create a high-growth, high-differentiated ecosystem capable of sustainably reversing the seigniorage run amok that drove LUNC to zero. To this end, we prioritize our product design features in terms of primary essential features versus secondary optional features. Must-have features. 1. Balanced restructuring of bad debt, shrink USTC equivalent supply in as one-off of a manner as possible to return USTC to 1 USTN $1, while compensating USTN holders with equity in LUNC that our community could afford. That's also material to USTC holders' existing balances of USTC, but not enough to erode LUNC holders' support for the proposal. For our AFT to have confidence of the market, and especially third-party arbitragers defending AFT's currency peg in future crisis, we should, within reasonable means, respect the prior risk symmetry of USTC holders versus LUNC holders by giving USTC holders fair consideration for a shrunken USTM balance. Okay, so UST holders had upside capped at $1, but the first loss protection from LUNC holders from a risk perspective, they were bond holders. Above equity holders in the capital stack, i.e. equity holders took total losses before they took material losses. Luna holders had unlimited upside in protocol success in return for providing first loss protection to USTC holders. Risk-wise, they are equivalent to the equity holders. If LUNC holders throw USTC holders to the wolves, USTN LUNC arbitragers would assume they'd be treated equally poorly in a future crisis and would be less inclined to defend the peg in tail risk scenarios. B. Under TradFi precedent, debt holders of USTC holders sort of would vote on a debt restructuring. However, USTC holders have no votes in this process because the equity LUNC is the base layer governance token. That pretty much means you can only vote with Luna Classic. Out of ethical fairness as well as long-term credibility of USTN asset, we LUNC holders should act with USTC holders' interests in mind, even though we have no short-term financial. 2. Recollateralize the reserve, find on our own sufficient exogenous collateral backing for USTN, BTC or something else, so that the new USTN could have enough why can't I pronounce that word? Backing to be safe. Based on our conversation with potential outside investors, we believe 50% BTC. We also considered a gradual demurrage factor rebase of USTC with a very limited daily swap limit. However, we believe that re-enabling the swap, we would cause ARBs to close the market gap between LUNC and USTN and make the potential dilution LUNC holders would face a much higher and be less predictable versus a completely one-off rebasing. Collateralization is the minimum exogenous collateralization level required for market credibility. Our proposal assumes a 60% BTC collateralization ratio. Reserve decentralization. Manage the USTN reserves in a passive, fully on-chain programmatic manner to eliminate key man risks, maximize transparency, and increase investors' confidence during the volatile market periods by making protocol operations fully and publicly visible. A. Make sure that the on-chain reserve on its own retire 100% of the balance of the USTN in the event of a failure of the capital control system CCS. Understanding that the CCS will certainly fail at some point in the future due to some unforeseen confluence of improbable events, and equip the reserve to be a failsafe that prevents another hyperinflationary catastrophe. B. Create a TWBTC Terra wrapped BTC implementation for Terra Classic which doesn't currently exist. 4. Overhaul the capital control system, figure out everything that went wrong with Terra Classic's prior CCS and materially upgrade it. 5. Retain Terra's lack of fiat umbilical cord, which gave Terra a unique layer of decentralization and regulatory insulation relative to the fully collateralized stablecoins such as USDC. 6. In late 2022 or early 2023, open the LUNC USTN swap with very restrictive parameters. Okay, nice to have features. 1. Build or finance important adjacent infrastructure that can drive quick growth, such as A. On-chain BTC USTN liquidity pool for slippage, day-to-day reserve open market operations. B. A small USTN USDT USDC 3-pool curve on the mainnet. C. A protocol-owned bridge capable of securely storing the keys for protocol-owned BTC. We believe our proposal satisfies most of the nice-to-have goals on this ambitious list and all of the essentials at certain points when the market cap ratio of Luna Classic to USTC was significantly higher. The protocol was also positioned to satisfy all of them. However, at current LUNC price levels, that is no longer the case. A debt-to-equity swap, asset liabilities, and mechanics. First, we mapped all of the assets of TFL and key related parties which we could theoretically use to capitalize USTN. The community already owns 4.75% of all LUNC supply. Community smart contracts, the LFG and TFL related party addresses collectively own at least 49.8% of the USTC supply. So that's very interesting, because then if you slap on what's owned on CoinMarketCap, you know you're looking at sorry, not on CoinMarketCap, with what's in the Binance Hot Wallet, that puts you up at 70%, 73, yeah, so about 73% that puts that at, which is crazy. So as you can see here, you've got the what would be blacklisted here. You've got the label for the wallets. I'll leave a link to this in the description. In fact, I'll chuck a link to this right now in the. I don't know why I didn't do this to start with. Oh my god, I'm bringing up all sorts of different screens. Okay, let me get that in there. There you go. There is the link to that, just in case you want to sit and have a ponder at that. Nice little chart here for USTC holdings, LUNC holdings, and what other holdings there are to be collateralized if this all obviously goes ahead. So let me just take a sip from my tea. Holly, it's totally normal to get lost. Honestly, it's not hard, especially when it's not writ out in plain terms, and this is a pretty long white paper. There are 3 groups of relevant entities here: LunarGuard Foundation wallets, community-owned smart contracts, TFL and related parties. Off-chain assets: LFG, AVAX, BNB, BTC. Unfortunately, the 53.5 million of off-chain AVAX, BNB and BTC are beyond our reach. We strongly oppose the proposed redistribution of these assets to pre-Repeg USTC holders because it arbitrarily prioritizes them who likely sold out of the USTC at much more favorable prices over current USTC holders, and thus represents an I don't understand why I use this forward ink. Expropriation of wealth from LUNC and USTC community. However, our understanding is that these assets are wrapped up in legal process beyond our control, or the LFGs. It would require a change of heart, not just by LFG, which is very legally constrained in what it can do, but also an extremely diverse set of class actions litigants whose interests are fundamentally at the odds with those of current USTC holders. On-chain assets, USTC and LUNC. In Terra Classic's prior system, Luna collateralized not just USD, stablecoin tokens, USTC, but 21 other stablecoin tokens as well, interchangeable at Oracle prices determined by several data feeds to TradeFi FX markets. As of this writing, the only 3 stablecoin pools of any significance were USD, USTC, USDI, SDTC, and UKRW and KRTC. As you can see here, you have got the equivalent of what is obviously being shown, and he's pretty much backing up what he's saying with data. If 100% of the non-USD stablecoin tokens were swapped into USD USTC at market rates, the supply of USTC would be 10.736 billion, 49.79% of which would be claimable by the community. The assets we can use to redistribute via governance sum up to 4.47 billion USTC, 700 million of USDR stablecoins, 903 million USTC equivalent in the TFL SDR wallet, and 328.4 billion Luna Classic, or 5.37 billion USTC, and 328.4 billion Luna Classic in USD terms is 270 million. 3C. USTC intrinsic value. As an unbacked token, USTC's intrinsic value dropped to 0 when TFL disabled the LUNC USTC, then Luna UST. Swapped in mid-May, creating the blockchain equivalent of a debt default. USTC's intrinsic value today has 3 sources: the option value of LUNC chain partially recollateralizing USTC, the option value of Luna 2.0 or any other chain entirely partial to recollateralizing USTC, an unclear relationship with USTC holders sharing the airdrop of 50 million of LFG off-chain assets. To extend that, the airdrop takes current USTC ownership into account. We aren't sure how it will work. Thus, despite USTC's lack of formal backing, USTC has consistently traded at very high correlation to LUNC, but also at a large market cap discount, reflecting the reality that any sustainable recollateralization of USTC couldn't overly dilute LUNC holders or leave a dangerously low equity buffer. USTC also shown significant sensitivity to very large upwards moves in Luna's value. The LUNC USTN airdrop parameter. I'm just going to grab a drink out of the fridge, folks. Hang tight. Yeah, I know, right? Really long white paper. We've just gone past around 60% into it, folks. So 3D, the LUNC USTN airdrop parameter. The LUNC per USTN airdrop parameter for the swap 48.485 in the below example will ultimately have to be fixed in a governance vote, balancing LUNC holders' tolerance for dilution with compensating USTC holders fairly, and also with a safe level of BTC collateralization. The airdrop parameters apply to both private USTC holders and to the amount of LUNC gifted to the community pool smart contracts, the latter of which will help underwrite the BTC we need to collateralize USTN. So as you can see here, you've got the debt to equity swap, pre-swap, and then the swap stage. So if you're into all of the fine details, you can go in and look at that. So stay with me here as well, folks. I know people keep coming in and dropping out. It's a lot to absorb, I know. The community's 530 billion Lunar Classic, which is 250.884 billion new LUNC, combined with 263.559 billion Lunar Classic from the Oracle Rewards distributor and distribution core smart contracts, would be converted into community BTC, which never leaves the community's possession and acts as an insurance against LUNC hyperinflation during high stress scenarios. At that point, USTN in the community pool smart contract would be burnt, leaving 172.5 million USTN in circulation, 100% in the hands of private holders. Net of the Lunar Classic sold by the community pool to buy BTC for the community pool, the community is only looking at 250 billion new Lunar Classic, 3.6 created. This 250 billion new Lunar Classic would then be auto-staked across the active validator set and not be available for sale for at least 21 days. Post-swap, where we'd end up. The ecosystem in this example, we'd end up with USD 172.5 billion of the USTN backed by 147.13 USD worth of wrapped Bitcoin. In this model, there would be a very significant amount of wrapped Bitcoin, 25.3% USD value relative to the stable coin supply, or USD 40 million. The excess money, whether in wrapped BTC or USTN or something else, would bootstrap infrastructure essential for re-enabling cross-chain liquidity via protocol-owned assets, such as a 10 million to 10 million on-chain wrapped BTC to USTN liquidity pool, a USTN curve pool, and a protocol-owned or completely decentralized BTC bridge. Alternatively, instead of selling that excess Lunar Classic for BTC, the excess LUNC around 100 billion could simply be burnt, reducing the total dilation required from 500 billion to 400 billion. So I think it's 500 billion Lunar Classic coins now, not whatever it, yeah, I think it was 250 billion. So is it 500 billion or 400 billion? I feel like this white paper is overly complicated to bore the user, so you probably just go, put it through. It's a bit interesting. So and the thing is, right, as well, like these white papers need to be understandable as well to like the average Joe. I feel like this one's really overly complex for whatever reason. The ecosystem would start collecting tax revenue from the 5% USTN LUNC minimum swap tax, which it would inherit from UST Lunar regime. The purpose of this tax was to discourage Oracle manipulation attacks, and this to us would be a more efficient tax than the current 1.2% Tobin tax on most protocol interactions. So you've got another thing here below with all the little fine details. So yeah, Strafe probably going to want to come on and do a episode on it, buddy. If you've got time. I know you're a busy guy. USTC holders with 1,000 USTC valued at USD $30 would keep his 1,000 USTC, which would probably plunge in value post airdrop to something greater than zero, but much less than $30. And additionally have 30 USTN valued at $30 and 480 480, 485 of new Luna Classic, which is $15 staked across the active validator set with a typical 21-day staking lockup. His USTM would be 60% backed up by BTC. If he immediately dumped his USTN after the swap were re-enabled, he'd face a severe swap tax unless very few other dumps, in which case he'd be free to leave, and his free lunch would be taken away from him by the protocol. Basically, if through a completely voluntary process, the Luna Classic protocol would be buying back the USTC holders' debt at a premium of 50% plus UTC post-airdrop residual value, USTN exit tax if the USTC holder chose to dump his USTN. Woo! Brutal. A Luna Classic holder would face 503,890 over 6900, which equals 7.3 dilution. In this example, the actual amount would depend on the Luna Classic USTN swap rate. In return, he'd have voting control over a viable new product, USTM, with a unique balance of decentralization, growth potential, and resilience not offered by any stablecoin on the market today. We could power the protocol's next leg of growth. USTN adoption would in turn start to refill the Oracle rewards distributor, which LUNC stakers and validators depend on upon generating staking yields. He would also have voting control over the excess assets of the protocol required to stake the basic infrastructure we'll need to reactivate the chain. A validator would see the amount of Luna Classic staked to him go up by 50% relative to current levels staked. LUNC would go from 630 billion to 925 billion. This would significantly increase network security if a significant amount of USTN immediately tries to exit the system at the Repeg. The swap tax would aggressively tax their USTN and slowly redistribute it to the active validator set over a 2-year period. This was what gave the ORD such a large USTC balance in the first place, which is I think the Oracle rewards thing. The validators would also see the ORD start to replenish, as the ORD needs function in dual token mechanism in order to be replenished. As things stand today, it's gradually depleted with no replenishment in sight. But we've got some time on that, folks. Don't let that fudge you out. We do have some time left on that, around 1.5 years. As you can see, a reserve allocation example of USTN 1 billion to 60% BTC reserves. Key concepts. Tranching partition the reserves into 10 tranches. The first tranche begins swapping out BTC into USTN when the peg hits that tranche limit entry price. The protocol seeks out the best price for wrapped BTC primarily via an Ethereum mainnet. Re-racking, a semi-randomized but regular intervals or at every 5% change in the price of BTC re-rack the reserve tranches such that the bottom tranches are filled first. The decentralized reserve is designed as pragmatic, fully on-chain, fully transparent protocol-owned replacement to the Luna Foundation Guard. Its sole purpose is to use non-Terra reserve assets, BTC in our example, to defend USDC peg. The protocol would set a reserve target, we assume 60%. The target level of BTC to remain in reserves relative to UST in circulation. Whenever the reserves below its target, the protocols would do 2 things. 1. Redirect all revenues from taxes to buying BTC until the reserve is topped up. 2. At regular intervals, re-rack the tranches to fill them up from the bottom. 3. Once protocols had been breached its reserve level, the minimum swap tax would be raised to 1% and all protocols taxing excluding CCS would be redirected into the reserve. These reserves would generally be collected in the form of USTN, and governance could decide what to do with the revenue at a later date. 4. All tax revenues ex CCS fees would be reallocated towards LUNC burning in line with Luna's Columbus 3 upgrade. The decentralized reserve has 6 key product requirements. Just going to take a sip, folks. God, it's thirsty work talking. Yeah. Sorry about the gulping. Okay. Where were we? Smart contract-based automated defense of USTN Repeg using BTC reserves at full reserve capacity guarantee that the protocol can, at current BTC prices, retire 100% currency in circulation even in the event of a total CCS failure, thus averting a death spiral. Structure the reserve in a way that profits from taking from the other side of efforts to market sell large volumes of USTN and cannot be tricked into emptying its reserves, defending the peg at a very small discount to 1 USTN to 1 USDC, USDT or BUSD. Be able to flexibly adjust in the event of a gradual BTC bear market such that the reserve can, at some lower point VWAP, still retire up to 100% of USTN in circulation even in the event of a total failure of the capital control system, while using excess Tobin tax revenues to gradually refill successively higher tranches of the reserve. In the event of a significant price change in BTC relative to USD, we recommend a 5% as a threshold level. Caused by a catastrophic event, the tranches automatically re-rack, lower maintaining reserve capability to retire all USTN in circulation and avert a death spiral. Building a deep margin of safety, the DeFi industry standard, which has withstood multiple severe bear markets in 15 ppts. I think that's points per... Anyway, moving on. To account the unforeseeable, such as USTN BTC swap rates, significantly higher transaction fees during the high congestion periods, etc. Over-collateralized implementation of the decentralized reserve already operate on mainstream DeFi platforms that will have withstood multiple bear markets such as Aave, Compound and Maker. In these constructs, whether stablecoin or not, vaults of Ethereum, wrapped Bitcoin, etc. are liquidated when key risk thresholds are breached. These protocols held up extremely well during the 2022 DeFi apocalypse. The on-chain transparency of their liquidation transactions, running well into the billions of dollars, showed that the world of the model fundamentally works even under severe stress of an 80% bear market, minus 80% bear market, sorry. Our protocols proceed the design principles but takes a path of 100% indigenous? No, of course not. What? Stop it, Jay. Collateralized. Honestly, I'm just getting all my words mixed up right now. Collateralization offset by significantly reduced convertibility during periods of systematic stress, which brings us to another of Terra's key elements, its capital control system. 6. Capital control system basics. This is honestly an insane white paper. The key concept behind Terra's capital control system was that swap taxes from UST to Luna were generally low when nobody else was withdrawing UST and swapping UST into Luna, but would rise dramatically as more people withdrew more capital in a shorter period of time. Basically taxing withdrawals in proportion to how many other withdrawals were simultaneously being attempted and redistributing a significant percentage of their profits to the ecosystem, most committed participants, stakers and validators. The CCS combined with Luna equity was UST's key line of defense under the prior system, much more so than the LFG reserve. As UST depositors fled the system in greater numbers, the protocol would collect an escalating tax on their withdrawals. Deposit the UST into the Oracle rewards distributor and redistribute the income to stakers over a 2-year period from time of collection. This would perform 2 roles, taking UST out of circulation and redistributing it from system's weakest, fleeing users to its most dedicated supporters, Luna stakers. At the same time, Luna could be purchased on the open market by new traders willing to bet on Luna's survival, existing members bringing more outside capital to defend the protocol. Most of the time in the first basically the first part of 2022. The bear market when crypto crashed in general and the anchor protocol's TVL fell over 25%, the CCS worked as intended. However, it wasn't enough, and in May's crash, the CCS managed to retire 45% of total UST in circulation and only around 30% after accounting for 2.75 billion UST repurchased by LFG Guard during the crash. The below shows the UST Lunar theoretical swap tax curve using a USTN 10 million base pool under varying levels of systematic stress. Basically, it's going to show you exactly what happened during the DPEG. Don't need to keep going with that. Pretty much this goes on to explain, a bit more in depth about how the DPEG actually happened, but we'll just go through it. In addition to the base pool and pool delta, Terra also had a pool recovery period, most recently set to 36 blocks, which determine how quickly the pool delta would renormalize to zero, thus also taking the tax rate on the next withdrawal to near zero. The rate at which the tax rate went up during capital outflow events, as well as the rate which the tax renormalized to zero, was determined by interactions between the base pool delta and pool recovery period parameters. In reality, the CCS was seemingly managed via ad hoc, highly centralized parameters adjustments, and as far as we know, it never sustained collection rates above 40% for any period of time, even during extreme stress events. We believe this was because arbitrageurs had an insufficient incentive to defend the peg during high stress events when CCS taxes significantly exceeded 40%. We suspect the CCS curve will have to be reconfigured towards an S curve with a 45%-ish ceiling via the prior system, but this will require extensive further testing and validation. And the one thing I find with these proposals is they talk as if they're talking to another developer, but they're not. They're talking to a community. The people saying, buy USTC now. I mean, honestly, with Lunar Classic being minted in this, I can see it being a huge deal breaker just off of that. I'm not going to read the rest of that. Capital controls via convertibility trade-offs. I'm going to leave that to you folks. I'm going to leave the burn rates to you guys as well. And like a lot of this pretty much then goes on to explain about how much USTN could be put into circulation and how many coins could be minted and stuff like that. But like I've stated, that is pretty much 18 pages of I guess, how many of you actually understand what we've just spoken about? How many of you understand? Let me know in the comment section how many of you have just understood exactly what has been said to you. Because it's always very important that you guys understand, that this isn't a USTC repeg either. In fact, it's like pretty much giving USTC the big FU, so to speak. So the regulatory comments very interesting. So regarding the stablecoin legislation reportedly being drafted into Washington DC, we don't know anything that anyone else doesn't. It's obviously aimed at the now defunct Terra model of pre-May 2022, but based on the little we've read thus far, it widely misses the mark. We would not note that the US financial and regulatory regime is already extraordinarily hostile to all kinds of stablecoins. And this is something I've been stating loads to my community is, USDC or anyone trying to get involved with it's going to just get dragged into a court case with it, in my opinion. So it's always something to think about when we're trying to dip our toes in the water with USTC, so to speak. So, mate, can you explain a little further on the dilation of LUNC? Yeah, so I'm going to get Strafe Cole on. Yeah, of course you understand Strafe, because he's written it as if he's talking to you, whereas, he's not. And, it's not always about... Like, this is one thing I don't like, is people who consider other people, dumb because they're don't understand developer talk and stuff like that. And people are smart in their own ways. We're all smart in our own perfect little ways. And, you know, I wouldn't be able to tell you the first thing how to, like, there's so many things I wouldn't know how to do, you know, to do with mechanics and stuff like that. But you bring a mechanic in here and he's like a wizard. But, you know, it's everybody's smart in their own different ways. And I hope a more simple explanation for this comes out for the community, because it's hard for me to try and explain this when there's a lot of what I see unnecessary stuff in here. But I guess the main idea is to create a new coin or token, a non-fungible token, or an AFT. And yeah, so I'll leave a link to this in the description for this live stream and stuff like that, folks. And let me know what you think. And remember, it's not a proposal yet. It's not been put up or anything like that. It's pretty much just this white paper at the moment. And I guess he's trying to just gauge, you know, a way to do this. It's an AFT, folks, an algorithmic fungible token. But like it states at the bottom, do remember that this could, you know, get caught up in a court case and stuff like that. That's very important to remember that. And just leaving you folks on a end note, do remember the burn ticker is up now for the hashtag burn a lot initiative. Okay, folks. So if you want to see how much has actually been burnt from that burn a lot initiative, you can see it right there. Okay, folks. Have a really nice day wherever you are. I really appreciate you all showing up in the live stream today. Really appreciate it. I'll try and get straight on to do a bit more of a technical explanation from a developer standpoint on it, and I'll possibly look to be getting Alex on possibly to speak to you guys about it as well, because I think it's a brilliant idea. I guess we just need to get our heads around this, you know, minting of more Luna Classic, I guess, is the biggest issue in there I would see for the community. So everybody stay safe out there. Really appreciate you all showing up, and you know, I'm not a financial advisor. Beware of scammers, beware of doppelgangers, beware of anyone pretending to be me. Smash the like button on the way out if you can, and I'll catch you in the next one. Shalom!